Okay, let's go now with the review question chapter 15. Starting point, I'm gonna start with this question 9. So what I want you to remember, very simple. I want you to remember that. What we're doing is we're chasing with the bonds, we're chasing two things. The principal or original amount of the bonds, or original amount, or the amount that we have to pay at the maturity of the bonds, or the stated amount on the bonds, same amount. We, in this case, we have 1,500,000. That's the first thing that we chase, amount of the bonds. Second, we're chasing the interest rate that these bonds gonna pay. Bonds pay interest of 6% in this case. So our bonds pay 6%. Term of the bonds is 10 years. Okay, we have this information. Great, awesome. What we're gonna do now? We're gonna check market. Where is the market? And for the market, we have interest on the market. So in this case, the market gives you 7%. Which one is higher? Market or the bonds?
Market.
Market is higher. Is this obvious for everybody that the market is higher? Let's put here market. Market interest, 7%. If the market is higher than our bonds, who is that wise investor who's gonna invest in our bonds? Is there anyone who wants to invest in our bonds? I'm paying 6%. Market pays 7%.
No, there will not be any
Investors,
investors because the market pays more
more
technically.
time more. So what's gonna make the people come and get my bonds? Give me their money to me by they knowing that they're gonna get less interest than the market. What do I have to give them?
Cash?
Why would you give them cash? So
Actually, sorry,
question.
shares.
So question. I'm a bakery producer. I'm doing my bread. I'm selling my bread, I'm selling it for $4.50 when it's fresh. By the end of the day, I still have 5 breads that's sitting on my shelf. I want to sell them by the end of the day. Nobody's buying because it's already old. How can I sell them?
Yeah, I agree with Monica. It's to discount the breads.
I have to give them my breads discount. Make sense? If I want to sell my bread, I have to give them discount. Same thing with the bonds. Market pay you 7%. I'm giving you 6. What do I have to give you? Discount. Why I'm giving you discount? Because I want to sell you something that is not favorable. Now, what's going to happen if the opposite happens? Let's flip now. Our bonds pay 8%. Market pays 7%. So which one is higher now? the bonds pay more. So can I capitalize on this? Means can I take the benefits from the fact that I'm paying more than the market? And how can I get the benefits from the fact that I'm paying more than the market? Now, market has to give you discount, right? If I sell it for the higher price, that means I can charge the people premium. Can you give me example in real life where you're going somewhere and you're paying premium and you don't even blink? Whatever price they ask you, you're just paying it just to have the item. Yeah, the gas price. Yeah, the gas price. Yes, definitely. FIFA World Cup ticket. Yes, that's a very good example. But the thing is, that will be now. Listen, with the FIFA World Cup tickets, that will be tricky. Let's explore on that opportunity because what's going to happen? The 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 things that's going now. Most likely, most of the people they're not gonna come. Yes, Christmas ticket, no questions about it. Where is the other period when the company is charging premium price on something that usually is charging the same? It's coming. It's called chocolate Valentine's. Yes. No, no, no. We're talking about the plane tickets. Chocolate on Valentine's or flower on the
Spring
Valentine's.
break.
Spring, not spring break. Yeah, spring break. Yes, but the other one, the biggest break, the summer break. Yes. Why? Because all the schools are going, letting kids going on the same time, and all the family, if they want to spend some time with their kids on vacation, that's why they're booking the tickets. And surprisingly, the airline company knows about it. So what they're gonna do? They're gonna capitalize by charging premium. When that season finish and there's no people want to buy tickets, what they're gonna give you? They're gonna give you now discount. The price is going down. Right now, when was that? My wife was telling me, Las Vegas start to offer all inclusive. Can you believe in Las Vegas all inclusive? Why? Because there's nobody wants to go there. Canadian market pretty much dead. The other thing that's going to happen, let's explore the FIFA Cup. Now, I don't want to be the prophecy here, but most of the people who usually follow the soccer is going to be scared to travel. And if the things that going on right now doesn't finish very fast, the price of the ticket's going to be the airplane ticket's going to be ginormous. So what that means, most of the reservations going to be people not traveling. Yeah, obviously, people from South America, they're not gonna come to US. Why would they call? And the other thing is, people will be scared to go to Mexico or to US. So, listen, I won't be surprised. I won't be surprised if on in Vancouver, what you can do is monitor this. It's very that will be interesting phenomena you to watch. I saw the games. Some famously, what's that? Very famously unfamous country is gonna play on in here in Vancouver, which is great for the public. But means that their natural supporters most likely will not make it. So that means the stadium will be not filled to some extent. That means all the people who already bought the tickets, hoping that they capitalize on the premium when the people come and buy a ticket in front of the stadium, they have to sell the tickets. Do you understand this? Yes, let's say I know people who bought like 100 tickets already, and they're waiting for the game to sell those tickets double or triple. And that's how they make a living. But now we're going to the interesting point that you might go there on the stadium, wait the game starts, wait the game to start, and 10 minutes after the game starts, ask them, I have $100. Do you want it for your ticket or you want your ticket to die? And see what they're gonna say. On that point, they're gonna take everything that you offer them. Why? Because after another 5 minutes, that ticket become useless.
So that same concept applies to bonds as well, right?
Exactly. Exactly, Xavier. Once the concert starts, once the game starts, once the market goes sideways, you try to minimize the losses. Now we're not talking about here gain. Gain is gone. You're making gain before the concert starts or before the soccer game starts. When it starts and you still have merchant of the ticket, the question is how less you can lose, how to minimize the losses that you already have. That's where the question will be. And you can capitalize that on that thing by paying the discount price. So now let's go to our example now. We already established. We see how much we pay on the bonds when we see the original principal or stated amount. This is how much you have to pay after 10 years. The question is how much you're going to get today. Again, if you're paying interest less than the market, you have to give people discount. So if my bonds amount is $1,500,000 and you actually get cash, the cash that you get is what says here 1,393,407. Did you get more cash or less cash?
Less obviously.
That's obviously. So what's happened? Did you sell your bonds on the premium or discount?
Discount.
Discount. Clearly discount. Okay. So how much is the discount? Can we calculate the discount right away? Will be original price that you have to pay minus the cash that you get. Correct? So what will be the journal entry? On the sell on the time that you issuing the bonds. What will be the journal entry? Debit. What you getting? What did you get? What the people give you?
Cash.
Cash. How much cash did you get?
106,593.
Okay. The cash is clear. We're gonna
Oops.
get 1,393,407. That's the cash that you're getting. 1,000,000. It says in the question, you get cash proceeds of 1,393,407. How much you have to pay when the bonds are gone? Bonds payable. How much you have to pay? When the bond mature, how much you have to pay them people? 1.5, 1,000,005. What there's a question mark, Lily? They shouldn't be question mark. This is a contract. So which one is short, debit or credit?
Debit is short, implying
Debit
it's the
or short.
bonds.
So debit is gonna go where? Which account? Are we getting more or getting less? Discount on bond
On bonds payable.
payable. So what's happened now? Those two together, bonds and bonds payable, start going side by side. What's the objective? This discount by the end of the life of the bonds to disappear, correct? That's the objective. How can it disappear discount? By amortizing it. When we're gonna, at which event's gonna trigger amortization? When we pay interest. Why? Because we know exactly how much interest we have to pay every payment day. 6% of the outstanding amount. Now, how much will be the interest expense? That will be the different story. And that's why we need to do the schedule, which is going to start with the first year zero, when we issue the bonds, and then we're going to go year one, year two, year three, four, five, six, seven, eight, nine, 10, all the way to year 10. So what we need, balance in the beginning. Then we have a payment. Do we know how much we're paying for the interest based on the original contract? How much will be the payment every year if you assume those are yearly? Let's see, 7% pay semi-annually. Sorry, it's not year annual, it's semi-annual payments. So we're gonna have payments 10 years, but 2 times per year. Total payments will be 20 payments. So how much will be the amount of the payment? We have to pay payment amount of the payment date will be 1,500 times 6%, 1,500,000 times 6% divided by 2, 45,000. So every time we have to pay 45,000. And that's how many payments we have to make? In this case, 20 payments. No, it's not longer than. We have to go with the payments. Payment 1, payment 2, and keep going with the 20 payments. That's gonna be a long, long, long chart. Let's see, where's the 20 payment? Here, payment. And how this payment's gonna change? Is it gonna change? No. So I can easily copy this and post it all the way to the end. Every time when I have to pay interest, I have to pay these people $45,000. I may don't want to pay, but that's the contract says I have to pay them. So next thing what I have to do, I have to have a interest expense. Payment is done. What I'm trying to find out here is, do you remember what will be uh, the, the journal entry? Let's go with the journal entry at the payment date. I'm gonna have debit interest expense. Why? Because I'm paying interest. And credit, let's go with simple one. Credit is cash. I already know the payment of my cash. Now what I have to find out, how much is my interest payment? And I'm paying interest using the market rate, correct? Which market rate is 7%. But since I'm paying it 2 times, the interest payment will be 7% divided by 2. So that will be 7% percent divided by 2 times per year, or 7% divided by 2. So every time I have to pay 3.5%. That's not the percentage I'm chasing. The percentage, 3.15%. Now, on what I'm gonna pay that interest payment? On the outstanding balance, correct? So let's leave it for now. Let's keep to the next one. Next column will be difference. And that will difference gonna come between the payment and interest expense. That will be not interest payment. That's wrong terminology, expense. So the difference gonna come between the payment minus the interest expense. That's gonna give me difference. Next thing, we're gonna have a discount. And the last thing will be the balance. I'm gonna squeeze those one, maybe they make this one ginormous, and then will be the ending balance. That will be beginning balance. This one will be ending balance. Do I know my discount before I even start my calculation? I already have it, right? So my discount is 106,593. Do I know the cash that I get? I know it. This is the cash that I get. Now the question is, if I get calculation across the discount and the balance of the cash that I get, how much gonna give me? Most likely it's gonna give me exactly the amount of the bonds outstanding. 1.5. Correct? Okay, let's start. First period. My beginning balance, what's my beginning balance? The ending balance of the first one, which is exactly the amount of cash that I get. I'm paying 45,000 because I have to pay at the end 1.5 million, and on 1.5 million I owe 6% annual or 3% per payment. Now my interest expense will be based on the market, but I'm going to calculate it based on the outstanding amount or the amount of the balance that I have. So the money that I get is that much. Time, 3.5%, which I'm going to lock with F4 function on the top. My interest expense going to be 48,769. Now, let's think about it. Does that make sense? Is it make sense my interest expense to be more than the payment? Well, the payment is based on 3%. The interest expense is based on the 3.5. Even if the balance is less than the original amount, it still makes sense to be higher than the payment. Then I'm going to have a difference, which difference will be interest expense less the payment amount, which is 3,769. Now, what's my objective with the discount? And what's my objective with the balance? At the end of the period 20, my discount to be 0 and my balance on the bonds to be 1.5 million. Right? That's my objective. That's why I'm doing this schedule, because I want to achieve this objective. Make sense? So the total here will be exactly the same. Let's see if we can achieve this. What that means? That means I have to start to reducing my discount. With how much? With the difference between the interest expense and the cash payment. And interest payment in this case, paying by cash. So that will be my original discount less the difference. Okay, I get a new discount. But at the same time, I have to increase the balance now, because my objective is to keep them 1.5. If I don't increase the balance, then my balance here will be, it's not going to be 1.5. So how can I increase it? My ending balance plus the difference. What's going to happen next period? Next period is going to happen the same. Now, beginning balance, it's going to be the new balance, which already include the difference between the interest expense and the interest payment from the period 1. On the new balance, I'm going to calculate the interest based on the market. And I'm going to lock again that cell. And that's going to give me the new amount. That new amount is going to be my difference between the interest expense and interest payment. That amount is going to start reducing further my discount. I'm locking the cell with F4 function on the top above the numbers on the keyboard. Minus the difference. And that will be balance plus the difference. Again, I'm keeping my objective to stay 1.5. So let me show you here. What's going to happen? You're highlighting the one that you want to lock. What that means? You have two options here. Go in the dollar sign and put the dollar sign in front of the letter, the sales column, and the sales row. That's option 1. Option 2 is function 4 on the top above the numbers. When you click it once, let's see if it highlight the number. If you click one, lock both. If you click it again, it's gonna lock the row. If you click again, it's gonna lock the column. If you click one more time, unlock everything. And again, if you want to play, and you're gonna see this. Now I'm moving somewhere else, which I shouldn't be moving. So I'm changing the formula. Let's go back one and just lock the cell. Let's say it's locked. So once I do it on the two lines and everything looks fine, I can easily grab it and drag it all the way down. Let's see what's going to happen now. Obviously, this is not going to happen because I'm missing those numbers. I'm going to grab this one and going to drag it down. Again, only the first row is going to happen. Next one, I'm going to grab it, drag it down. Now I have something interesting. First line is correct, everything else is wrong. Let's go to discount, apply the same thing with discount. Everything going whack now. And the last one is the ending balance. When I drag the ending balance, let's see what's going to happen now. And I achieve my objective. I have 0.05% or 5 cents difference because of the rounding, which is acceptable in this case. What's been used? The discount has been used. You're paying for the using the money. Are you using the other people's money? No, we don't have to log the sales. Are you using the other people's money? That's a good question here. Expense means that we use up something. What we use? What we're using, people? Do we have cash? In the first place, why do we issue bonds? Because we want cash. So what we're using? Others people cash. When we use the other people cash, we have to pay them interest expense. I mean, interest expense for us because we paying the interest. For them, there will be interest income because they are the one who getting the interest, right? So once you have so now on the exam, you don't have to do this. You don't have to do the entire schedule. You have two options. Either you're going to have to do the first two columns, either the last two columns. I'm not going to ask you to do the entire schedule. That's boring. Repetition is mother of the knowledge, yes, but it's father of stupidity as well. So too much repetition is just useless. For that reason, I want you to show me that you know to do the first two lines. If you show me that you can do the first two lines, that means you can do the entire schedule.
I noticed in the chat that Lily just asked random question. This is focus on the customer side.
No, it's not customer side. It's focus on the liability side. Because the course and chapter 15 is on the long-term liability. We went to chapter 16. On the chapter 16, we're looking at on the other side. Lily, for who is the liability here? Who issued the bonds? Who owes the money? The bond issuer or the bond holder? But who hold the liability? Bond issuer or the bond holder? Think about it. I'm holding the bonds. So at the end of when the bonds mature, what I'm gonna get? Or what I have to give? The bond issuer, right? So the same thing is, watch this. Imagine this. I won Lotto Max. I didn't want it, but imagine I won it. What I'm holding?
You're holding cash?
No, I'm holding a ticket.
Oh,
I'm
okay.
holding a Lotto ticket. Now, they're holding my cash. Make sense? So who win the lottery? The one who holding the ticket. Now, He's the one who's gonna receive the cash. Make sense? So in this case, the bondholder is the one who has the ticket. For what? For $1.5 million. The other person has obligation to pay him those one at the maturity.
So a quick question, Ivan. I was kind of
Yes,
wondering about something. So like basically, what on top of knowing accounting, like that, like who is like bonds and so on and how they work, you have to watch the news and the financial news and use macroeconomics, like the subjects. I mean, the stuff you learn from macroeconomics in order to understand what's going to happen in the future because that's the subject that teaches you how to predict the future based on supply and demand.
that's one thing to do. The other thing is to use artificial intelligence.
So artificial intelligence is now predicting the future.
Well, artificial intelligence can hold the information, which can be collected instantly from any possible resources out there.
Yeah, but there's a
Unless in the movie Limitless, I don't see how you can hold that information.
yeah
Have
because
you
like
have
technically
you
you would
watched the
have to
movie?
evaluate the source as well to
Have you
like,
watched the movie Limitless?
no, I have not.
Please watch it. Write yourself down to watch the movie Limitless, and you're gonna see what's going on there.
Does the database Cetron on Demand at Douglas College at the Douglas College Library website have that movie? Do you think?
I don't know. Let's focus now on this one. We have to focus on this one, people. Let's go because once we cover the questions, then we can talk about other things. So now we have the entire chart. Let's prepare the journal entry for the first interest expense. My interest expense is gonna be the interest expense. My cash payment is gonna be my cash payment. And the last one left, the discount. So let's put the interest expense. Interest expense in my case is gonna be 48,769. Cash that I'm paying, I already know it, 45,000. Now the question is, do I need debit or credit? Debit. From where I'm gonna get that debit? From the discount on bonds payable. And that discount is equal to difference between the interest expense and interest payment. Why debit? Okay, let's think about it. Yeah, you're right. Why debit? Because when you're adding more debit, it's getting worse, right? Yeah, Lily, you're totally right. If we keep adding debit, that doesn't solve our problem. So on which side we want the 3,000 on the debit side or credit side? On the credit, okay, let's move it to the credit. So let's get rid of this line completely. Thank you, Lily. If we keep adding edit, that doesn't solve our problem. Our problem is that we are not in balance. Are we in balance now? Is our journal entry in balance? Yes, it is. So we're done with this. Okay, let's move now to the next question. That was first question that I wanted to see. Let's move now to the next question. This company issue 10 millions, 7%, 20%, 20 years bonds at premium. The bond are retired prior to maturity. This is the question that you're gonna have. Those bonds are retired prior to maturity at 102. The book value of the bonds at this time at 10,453,000. This company amortizes the premium using the effective interest rate method. So what was the contract rate on the bonds at the time of the issuance of the bonds? Higher or less than the market? So basically, what says is the bonds pay interest, right? How much the interest on the bond? We already know it. It's 7%, correct? And then we have a market interest. Which one's higher if we have premium? Market or the bonds?
The bonds.
The bonds is higher. Okay, good. So our market is somewhere else. Where exactly is, we don't know. We cannot even calculate it at this point. Because we have premium, right? Once we have premium, means that the bonds, interest on the bonds is higher than the market. We already established this on the previous question 9. Okay, now currently the book value of the bond is 10,453. What that means? We have the bonds payable. How much is my bond payable? How much I have to pay at 20 years at the end of the life of the bonds? 10 million. Why is question, Lily? Why are you questioning it? I want you to be certain about this. It's 10 million. Now the question is, how much is the premium to amortize? It doesn't matter. Do we have a premium?
Yes, we do.
Which one is higher? The interest on the bonds or interest on the market? Interest on the bonds, correct?
Interest on the bonds, yeah.
How much is the market interest at this point there's no question about that.
Yeah, it's 7%.
That's no the where no where the market is, that's irrelevant.
Oh, okay.
We don't need it. I
Yeah.
don't need the market here, right? How much is the market? I don't need it. Now the other thing that I need are the date of the sale. When do we don't use the PV formula in these questions. We may not have to use the PV formula at all. Up to this point, we're not using the PV formula. But if you want, we can go back to question 9 and we can use the PV formula. But just that's only and only if the information is not given to you. Then you're using the PV formula. But anyway, I'm going to show you a question with the PV formula. Let's go here. The book value of the bonds is 10,453. How much is my premium? If the book value is 10,453. That should be 453,000, correct? Yes. Okay. So at some point, I have the bonds. Next day, I don't have them. I retire them on 102. What that means to you? When you see 102, that means 102, you can look at as a percentage. That's another way to look at it. Yes, 1.02. Thank you, Xiaolin. So now let's try to prepare the journal entry for the retirement of the bonds. How you get the premium is given on the question. I'm not giving it. I'm not getting it. That's the question. That's how you're gonna see it on the question if you see this question. You don't have to calculate it in this case. It's gonna be given to you. So let's eliminate those bonds payable. Bonds payable, when you issue the bonds payable, that's sitting as a liability, correct? If I eliminate it, I have to debit it. Let's debit bonds payable. How much is my bond payable that I have to eliminate from my books? It's $10 million, correct? $10 million gone out from my books. Next thing that's gone out of my cash account is the cash, correct? Because those people for those bonds payable, they want cash. They're not going to settle on anything else. Credit, cash. And how much cash I paid, Lily? If I issue my bonds, if I at maturity, I retire the bonds on 102. Not Lily, Xiaolin. Sorry. How much cash I paid? 10 million times 1.02, correct? Okay, let's pay that one. 10 million times 1.02. So I paid 10,200,000 dollars. Bonds gone. Now, can I keep the premium on the bonds payable if I don't have the bonds?
No,
No, I have to get rid of that premium. Now, on which side I'm gonna get rid of the premium, on the debit side or the credit side?
credit.
So before we go with this, yes, it says 102, but 102 is the percentage. So 102 divided by 100, how much is it? So before we go debit and credit, let's think about something. Let's go back to issue the bonds. Let's go to the time when we issue the bonds. Let's pretend that we issue the bonds, and for the bonds we get 10,453,000. Make sense? Let's pretend that that's how much we get. So debit, cash, we get more premium, 10,453,123. Credit, cash, we paid cash. Let's pretend we pay, sorry. So credit will be bonds payable. Bonds payable, not bonds, bonds. We're gonna come to that one a little bit later before we balance it. And before we balance it, I want to think about something else. Bonds payable, 10 million. Correct? Now I have to balance my entry. At the issuance of the bonds, let's pretend again that we get 10,453,000 cash and we issue the bonds payable. Our bonds that we have to pay after the period of time is 10 million. Where do I need to record the premium? Debit or credit? Credit. So credit premium. So I initially creating the premium on which side? On debit side or credit side? On the credit. So in order to eliminate the premium, what do I have to do? Debit premium or credit premium? Debit. Okay. So let's debit it, eliminate it. Make sense? Now, do you understand why we have to debit the premium? This is for the issuance, when we issue the bonds. This is when we retire. Now I know my carrying value of the premium is 453. So in order to eliminate it, I have to put it on the debit side. Debit premium on bond payable with 453, 123. And the premium is gone. Am I in balance on this entry on retirement? No. What do I need? Debit or credit? Credit. Since I'm since I'm retiring the bonds and closing the bonds and purchasing the bonds back, and those are gone. If I have difference on the credit, what's that gonna give me? Gain or loss? Stella, what stays on the credit side? Gain or loss?
Loss.
On the credit side, Stella.
Oh, on the credit side,
Yes.
so we gain the money then.
So what we have, gain or loss?
I think gain. Gain credit cash.
I don't want you to think. I don't want you to think here. What stays on the credit? Think about it. What is usually in the credit? Gain and what else? Sales, which is
Yes.
always positive for us. Is the gain positive for us?
Yes.
Yes. Okay, let's go with the gain then. Gain on sales of bonds. Oh no, retirement, sorry, of retirement of bonds payable. And our gain in this case will be this one plus this one minus that one. Now we in balance, correct? Remember, when we're retiring something, when cash is involved, eliminate the liability, bond payable. Eliminate companion premium or discount. If it's premium, obviously on the debit side. If it's a discount, it has to be on the credit side. See how much cash you get and see what you need, debit or credit. If you need credit, gain. If you need debit, it's gonna be loss. Make sense? So do you want me to make it loss so you can see the scenario at loss?
Okay, sure.
Bond retired on 106. Let's do down the journal entry. Debit. What we retired? Liability gone, right? Bond payable. And that's $10 million, no longer payable. Loss has gone. Sorry, the liability has gone. We already know that we have to eliminate the premium on the debit side. Let's eliminate the premium, debit premium on bond payable. And that premium is for 453, 453, 123. Premium's gone. Now let's pay the cash. Actually, yeah, let's leave it here. Oh, should be here, right? Should be right here. I want to keep it consistent to see be in the same column. So let's keep those one right here. Now the people who's gonna ask us, you want your bonds back, you have to pay me cash. Let's pay the cash. Credit, cash. How much cash we gonna pay in this case? 106% of the outstanding, or 1.6, yes. So in total will be 10 million times 1.06. So we're paying 10,600, 10,600,000 cash. Are we in balance
No, we're not. We're short on debit.
on the debit? So what we get, gain or loss? What's on the debit side? Loss.
Lots. Uh,
On retirement of bonds payable. And how much will be that loss? It's gonna be equal to 10,600,000 minus 10 million minus 453 or $147,000 loss. That's how you're getting the loss. That will be question 10. Let's move to the next one. That's a cash flow statement. That's another cash flow statement. That's another cash flow statement. Before I move to the cash flow statement, let's create here one sheet. This one, this one, this one. And let's label it question 11. So on this question, what we're gonna do is very simple. Do you remember the mortgages? The question will be retirement of the bonds. So let's go now. Or do you remember the mortgages? If you don't remember, let's go to the mortgages.
I don't remember them.
Let's go to the mortgages then. Let me share my screen. And let's go to the mortgage calculator. And we're chasing this mortgage calculator that come directly from the Canada government. Let's pretend that we want to buy something for $500,000. The interest that we're gonna pay is 4.85% over 25 years amortization periods. We're gonna pay those one bi-weekly, every 2 weeks, terms with 5 years. No prepayments, nothing like that. Let's calculate and see how much we have to pay. So every time, every period, we have to pay 1,321.79. So if we go to the summary here, summary report, the summary report is going to give us this chart. So once I have this chart up to this point, let's flip it on our Excel spreadsheet right here. Once I have this chart, for accounting purposes, I have to do the journal entry. Let's go payment number one. What will be my journal entry at the payment number one? Debit. How much is the interest that I'm paying to the bank? Let me see what you're saying on the chat room. Debit, interest, expense. Interest expense is 923.41. Debit, what else we paying besides the interest expense? Mort, principal. How much we pay on the principal? 398.39. Correct? Give me the credit now. What the bank wants from us? Cash. And how much we have to pay cash? 1,321.79. Make sense? What's going to happen at payment number two? What's going to change? Is the cash going to change? Is the cash ever going to change within those 5 years? No. What's going to change? What is changing? Interest and principal is changing. Why the interest expense going down? Because the principal going down. With how much? With the principal payment. And since my interest rate here annual is 4.85, the portion of that because every payment is every 2 weeks for the 14 days, the interest, that's gonna be the interest fraction that's gonna start reducing my interest payment. And in the next one, I'm gonna have those two is gonna repeat themselves. Cash always gonna be the same, but now the interest expense gonna be that much, and the principal is gonna be that much. And keep going, keep going, keep going for another, sorry, not here. Those gonna be right here. And keep going, keep going, keep going. Let me stop sharing this and share my new screen. So once I flip it on the Excel spreadsheet, what's gonna happen? On payment one, I'm gonna have the interest expense, 923.41. Mortgage principal, 398.39. Cash, 1379. Next payment, interest expense, that will be mort principal, and keep going and keep going and keep going and keep going until you pay your mortgage. Next period, what's going to happen next period? Well, we're just repeating the same debit and credits on payment 3. What the only thing that we're going to change, the amounts. Payment 3, this one will be our premium, interest expense. This one will be our principal, and this one will be our total amount of the payment. This is the question that you're gonna have. The question is gonna give you the how much your payment is, how much is your interest, how much is your principal. Then you have to do the journal entry. Can you do the journal entry? No. Yes. You'll be provided with the schedule. So if again the information from this comes from this schedule. And as you can see, payments, 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 where the payment amount hasn't changed, the interest start getting less, the principal amount that you're paying on the mortgage start getting higher. And if you do this for, let's see how many payments you have to make. We have to make 649 payments. Actually, 650 payments. And this is the summary of this, but again, we're not gonna spend time on this. That's not the objective here. The objective is you to learn how to do based on the schedule, how to do the journal entry. That was the objective on the mortgage and principals. Last question is the calculation of the using the net present value calculation formula. So for this question, again, the first what you have to do, bond value, interest on the bonds that you paying, amount of the time per year that you paying the interest, come up with the interest payment, and the interest on the payment. Then go to the interest payment, which is important for our calculation. That amount's never gonna change. Bond value is important amount for us. I'm gonna highlight it with green. Then we're gonna see how many total payments we're gonna have based on the number of the periods and based on the years and number of payments per year, we're gonna get the total payments. Then we're gonna start comparing the interest on the market. with the interest that we pay. If the interest that we pay is more than the interest on the market, we're going to have a premium. If the interest on the market is more than what we pay, we're going to have discount. In this case, we have premium because we pay more interest than the market pays. Interest on the market, in this case, the market interest on the every single payment will be 225 point, and that's what we're going to use for our calculation in order to calculate the present value. So the present value of the bonds simply will be calculated by getting the formula, going to financials, scroll down to the present value, and start plugging the information. First, gonna ask you for the rate. Which rate? The interest rate. Even in the formula is written, is the interest rate on the market. Plug that interest rate here. Number of the periods is the number of the payments period on the investment, 10. Payment. Since we're the one who's do the payments, for us is outflow, so we have to put a minus. And the payments on the interest is 25,300. Next one is the future value, which we have to pay on the bonds on the maturity date, which is $9,920,000. And for the type, we're not entering anything because we're paying every interest at the end of the period. And that's going to give us a present value of 960. Let's change this thing so the for our formula can actually work. So in here in this cell, I have to put all the formulas, not on the previous cell. So let's plug it here. Rate is this, period is 10, payment negative 25,300, and the future value negative 920,000, and that's what we have. So now we have the first journal entry, the cash that we're getting, the bond payable that we have to pay, and the premium. Then preparing our amortization schedule. For the amortization schedule, starting with the premium on the column, as we know the objective is to bring the premium to 0. Then we got in the ending balance, which is the cash that we get. And the objective is to bring that ending balance to the bond payable at the end of the period 10. And we start working on the numbers. Payment never gonna change, always gonna stay 25,300. We already know that. Interest expense always gonna be calculated based on the balance outstanding to the period time the interest expense from the market that we're using in our formula. We're gonna see the difference. That difference gonna start reducing our premium to bring it to 0, and gonna start reducing our ending balance to bring it down to $920,000. Once we drag the formulas, this is the schedule that we're gonna get. Next thing that we have to do is in the middle, between October and April, we're gonna have a reporting period. Now, for that reporting period, we have to calculate something on the reporting date. And that will be how much will be the accrual for the interest expense and the premium on the bonds. How are we going to do this? Our reporting date is December 31st. Our next payment is on April 30th. So we're going to see how many months we have between the last payment that we already made. This is all in the past. This is all in the future. Now we are between the past and the future. How distant we are from the future? We are 4 months from April, and 2 months already pass. So since 2 months pass, we have to show the interest expense for 2 months and 2 months only. How can we do this? We're going to get the amount for the payment that we have to make after 6 months or on April 30th. We're going to get that amount, 21,363.46, and we're going to time it time 2 out of 6 months. Same thing we're going to do with the difference between the payment and interest expense, or the amount that's going to reduce our premium. It's going to be equal again to 3,937 times 2 months out of 6 months. Now we can prepare our journal entry. First, we're going to have the interest expense for 2 months. Then we're going to have the interest premium on the bonds payable for 2 months, okay? And that's the amounts that we're going to get. Since we are accruing the interest, that will be our interest payable on December 31st. Once we do this, we're going to start working on the other part, on the other 4 months. First, we're going to get the amount on the schedule that we have to pay on April. We're going to deduct the 2 months that we already accrued on December 31st, and that's going to give us one amount. Then we're going to do exactly the same thing for the premium. We're going to see the difference that we going to have in our schedule for April 30th. We're going to deduct the amount for the 2 months that we already accrue on December 31st, and that's going to give us another amount. Cash is cash. We cannot change the cash. Cash always going to stay 25,000. So that brings us a difference. So let's see how much is that difference. That difference is going to be 25,300 minus 4 months interest expense plus 4 months premium. Let's try again. 25,300 minus this amount and minus this amount. And that gives us exactly the amount of interest payable that we already accrue on December 31st. So that now we clearly know that amount difference that we have is related for the 2 months accrual that we make on December 31st. So the last thing that left is to close that interest payable, debit interest payable, and our job is done. That's how we're dealing with those questions. Now let's go quickly over the cash flow statement. On the cash flow statement, you're going to see the question that's going to give you different scenarios and going to ask you for the effect on the cash. Is the cash going up or the cash going down? Where exactly the cash going? So let's go quickly and see how this is going to work. First one. Payment of interest taxes. Is this going to have decrease on the cash or increase on the cash? Down. Decrease on the cash. Issuance of preferred shares.
Increase,
Increase. Payment of the employee salaries.
decrease,
Decrease. Let's go with D. Collection of accounts receivable. Increase. Correct. Payment for delivery truck.
decrease,
Decrease. Repayment of the long-term loan. Principal only.
Decrease.
decrease. Receipt of the loan interest, increase. And payment of accounts payable,
Decrease.
decrease. Okay, that will be one question that you possibly can see. Let's go with the next one. In this question, very simple. With the information given, you have to prepare a cash flow statement. Can you put a plus minus? Can we also rename that? Absolutely. Once I post you the tabs, the Excel spreadsheet, you can rename the worksheet the way you want to rename it. Absolutely. You can do whatever you want with the worksheet. I'm gonna post it, and after that you work on it. Totally. Absolutely. Yes. So on this question, what you have to do is prepare the net cash flow outflow from operating activity only. Go logically. I'm going to explain again at the end, and I'm going to make you chat with the questions. So here, we're starting always with the net income. And the net income in our case, what is the net income? Is 79,000. Then we're chasing. Do we have a non-cash item? So now on the Pearson website, there will be different things. Now you have to drop down the menu and work with it. Adjustment for non-cash items. I'm gonna go with the way that I show you in the class. But now you can, on the Pearson, you can work different ways. First, we have amortization expense, which we have to add back, 12,000. Now, it might ask you to do the mid calculation. If it doesn't, so that will be here. That will be amortization expense. And that's going to be at amortization expense. We're going to add 12,000. And after we add this 12,000, our cash, adjusted cash will be 79 plus the 12,000 is going to be 91. Next, we have to do the changes in the working capital. First one, increase in accounts receivables. How this going to affect our cash? What's happened here? Which one is higher, beginning balance or ending balance? Lily, I'm going to post you in the very last worksheet. I'm going to post you chat with the questions. Which question to which chapter is related? So beginning balance is increasing in accounts receivables. Which one is higher, beginning balance or ending balance? Are we building accounts receivables or decreasing accounts receivables? Ending balance is higher. So what that means? Increasing. That means we're not collecting the sales, correct? How this going to affect our cash? We're not collecting the cash, correct? Accounts receivables, that will be negative 7,000. Make sense? Accounts payable. Let's see accounts payable, what's happened. we're decreasing accounts payable. So what's happened now? Which one is higher, beginning balance or ending balance? We paid off. So that means another decrease in the account, correct? Another 6,000 decrease. So the total decrease for us is, so how much is our cash from operating activity? This one minus this one is gonna be, sorry, plus in this case. Plus is gonna be 78,000. This is the type of question that you're gonna see for the cash flow operating activities. That's one possibility. The other possibility is, that's question number 14, obviously. The other possibility is like this. That will be a little bit more information, but again, it's going to have increase, decrease, increase, decrease, increase, decrease. Now, in these questions, you have to identify which one is related to the operating activity, which one is not. Net income is net income, that's the starting point, and you're going to have amortization expense, which is the adjustment for the non-cash item. Any gain, I don't see any gain and losses, so we don't have to worry about this. Then you have to identify cash received for issuing common shares, that's financing activity eliminated. Increase the current assets other than cash, we're eliminating that one. Repurchasing of the shares, we don't worry about this. Purchase of equipment, that's investment. Decrease in the current liability, that's working capital. Payment of notes payable, that's financing activity. Cash receivable, cash sales on land, that's investing, and that's pretty much what it is. And once you do this, you're done. So in this question, you have to be careful and which one is related to the current assets and current liability. And that's it. That will be a question 15. The last question. I think we spent a lot of time on chapter 17. If you want to refresh yourself on chapter 17, you can refresh on chapter 17 on the question that we did in class and the Excel spreadsheet that we prepare. On the last question, chapter 18, again on chapter 18, I want you to interpret which one is ratio is favorable, change in the ratio, which one is favorable, non-favorable, and how to calculate inventory turnover and accounts receivable turnover. And that will be your exam review.